tier entity. That's not prohibited. It will not get any tax benefits. The real trap is the Opportunity Zone Fund has this lower tier subsidiary partnership. It cannot contribute any services to that lower tier partnership, or that whole investment will be tainted, and you will not have an Opportunity Zone Fund. So it's fine to have a carried interest coming out of the top entity if you want, but that top entity cannot contribute any services to the lower tier entity, or you're going to blow the whole thing up. If you are interested in having a carried interest or a profits interest in addition to putting some cash in, you can do that as well. I am strongly encouraging my clients to do this through two separate partnership interests, and you have to do this through two separate regarded entities, because you can't just say this is Class A and this is Class B. For tax purposes, it all gets amalgamated together as a single partnership interest. But if you can have it clearly, so this is my interest in exchange for capital, and this is my interest in exchange for services, then that's one way to handle things. The problem with having both a capital interest and a carried interest as a part of a single partnership interest is we have special allocation rules, and you're not going to be getting the tax benefits that you're expecting from your capital interest. A lot of that's going to be allocated to the carry, and you won't get any tax benefits from that carry. Just one other note about carried interest. So you're probably aware that there's an incentive to hang on to investments for 10 years, at least in these. So you're not going to be getting the benefits of the carry as early as you often would think you would. So we have a lot of clients who are jacking up the fees that they're charging and taking less of a carry, because the carry is less valuable anyway under these structures.
Great. Yeah, thank you. So Susan, I'm going to go with you next. As far as you have the investor's perspective under wealth advisory, I'd like to just get your thoughts with the second regs. You know, any takeaways, any thoughts, concerns with these regs that you have, or recommendations that you'd give to your clients?
Sure. There's some considerations that I'd like to touch on with individuals who are considering this either as fund creators themselves or just one-off investors who want to partake of this opportunity. And the first thing is, and I think everybody has been saying this since the beginning, you can't let the tax tail wag the dog. It's an old adage, we've all heard it 100 times. We've been saying this as advisors. You can't let this happen. You have to look at the investment itself to make sure it's a good investment. So that was really true before, because particularly with opportunity funds who were trying to navigate this amorphous pool of information that really wasn't solid, people were kind of hoping that it was all going to work out. But now we have the second set of regs. So now what's interesting is you can rely more on the tax benefits to see if this is a good investment. And I'm starting to see this analysis in the presentations done by attorneys, CPAs, and other individuals as far as this is the tax break you can get compared to what you would receive if you didn't invest in the Qualified Opportunity Fund, which brings the tax benefit higher on the list of issues to consider when investing. So I think the second set of regs has solidified that for people. I think a lot of individuals never really cared and went ahead with it anyway, but now it's even the advisors who are pointing this out. So that's one thing. Another thing that I think is important for clients to consider is the form of entity. So when you're looking at the need to pay the taxes that are deferred on the original sale, so the taxes are going to be deferred on that original sale, the tax on the capital gain, until the earlier of December 31, 26, or the date of disposition. So at that date, the latest would be 2026, right? You've got to have the liquidity. How are you going to come up with that? So when you look at the form of entity that you're investing in, it's important to take that into account. Now with a partnership, you can actually get the cash that you need to pay your taxes. And the reason is because if it's done a certain way, let me say it that way, if the partnership obtains the cash in a certain way, what happens is when a partnership takes on debt, the partners get an increase in their basis, right? Because now they're responsible for the debt. So the partnership finances something, gets the cash, makes the distribution to the partners. It's going to match what their basis is because they just got the bump up and then they got the distribution that matches. So there's no deemed disposition of your qualified interest because you got a bump up in basis. Now that's not going to be true for the corporation or for a REIT. So you want to look at the form of entity before you invest. So that's another thing I like to address with them. And then finally, I think an interesting part of this discussion is looking at the state implications. The individual states are doing things differently, at least so far. Now, the reason for a lot of that is in some states, the way the tax law is written, they actually adopt, in their statutes, they adopt the most recently enacted federal tax code and just go with it. It's automatic. It's like an automatic election to do whatever the feds do. Other states have gone ahead and don't have the automatic, but they have said, okay, we're going to elect in because we like this. Then there are states who are electing in, but only under certain circumstances. Like, for example, if the qualified opportunity zone is in your state. So the states are absolutely not uniform, and that's normal with states, right? We have some with high taxes, some with no taxes, so we always consider the state taxes. But the other part of that is when you look at a qualified opportunity fund that may have a nationwide investment portfolio, and you're in a state that's only going to allow a tax break if you invest in that state, then you have to be sure that the fund will be able to allocate to you and identify the percentage of your investment that is in your state so you can get the tax break on that. So that's a big part of it.
Great, yeah. I think a nice segue would be into estate planning. So this was really addressed with the second regs. And anybody can address this if they want, but can I gift my interest in a fund? And what happens in the event of a death during the 10-year hold period is really two issues that I think are of mind on a lot of individuals. Yeah.
Well, I would love to start by saying that timing is everything, right? In life, timing is everything. So if you are an individual who owns a qualified opportunity fund interest or property, and you want to give it away during life, what can happen is a gift tax will be triggered. It's an inclusion event. The income tax and the gift tax could be triggered because of the fact that you gave it away during life. Now there is, though, a handy little exception to this rule, and that is if you give that interest to a certain type of trust. We call it a grantor trust, and what that means is that the person who set up the trust and put the asset in has agreed to be responsible for the income taxes of that trust. That's a general statement, because there's some wrinkles, but that's a general statement. So because the individual is responsible for the taxes, it's not what they call an inclusion event in the new regulations, because the same individual is still the owner for tax purposes. So that's one of the estate planning techniques to consider. And another part of that really, and one of the audience members is the first person who mentioned this to me. I just saw him a minute ago walking by. But sometimes we structure a transfer to a grantor trust for the benefit of our heirs in the form of a note sale, which avoids gift tax altogether. So you do a note sale. But the problem with that is, at the end of the term, when the beneficiary finally receives that asset, they receive it at the original basis. So they just get the carryover basis. So they did get it, you did avoid estate and gift tax, and that's great, but if that beneficiary now sells it, they've got the capital gain that you would have had. So that's pretty cool, that you can avoid the estate and gift tax. But if you want to avoid all of it, if you have the qualified opportunity fund in there and then you hold it for the 10 years and then it's distributed to the beneficiaries, you've got the full exclusion, so you avoid the tax. So
Great.
those are a couple things.
Yeah, any other thoughts or? Yeah.
A couple of notes, and these are just fine-tuning notes. I thought that was all terrific. The refinance distribution rule does not apply, and Susan was talking about using it probably to pay your tax in 2026, so it wouldn't apply to the exception I'm going to identify anyway. But a lot of people are talking about how soon can I refinance and make a distribution, and the prevailing thinking is you have to wait 2 years after you make your investment. The IRS has done this by reference to a code provision which has a 2-year rule in it. It's not the clearest thing in the world, but it is what the tax community has decided is that 2 years is an appropriate amount of time to wait. And on the gift and estate planning ideas, this whole bit about inclusion events, the whole inserting of inclusion events, the notion that I might sell my interest, I might contribute it to a partnership, I might contribute it to a corporation, I might die in owning it, and so on. I might be in a corporate transaction and they do a merger with another corporation. There's a whole bunch of things like this. The regs go on forever. They are incredibly complicated. I have referred to this as the Lawyers Relief Act. It is just amazing that if you are contemplating giving away as terrific an idea as the gift to the grantor trust is, don't do it at home, and make sure that you really are certain about the consequences. These are the inclusion event rules go on forever. You can sort of find some theory in them. To my way of thinking, if you give away an interest so that the person who receives it will wind up paying the tax instead of you, then it's probably an inclusion event, because the idea is you should pay the tax. On the other hand, and that's why the gift giving is a problem. On the other hand, if you give it away in a way that you still pay the tax, probably okay. So for example, contributing it to a partnership is probably okay, because the partnership will continue to allocate the built-in gain back to the person who made the contribution. But trying to apply rules of thumb and concept here are not a great idea. You should make sure you talk to an expert before you do any transfer of an interest that you get in an opportunity fund.
In connection with the estate planning, this is an issue that when comparing an opportunity zone investment to a 1031, it generally has been weighing in favor of a 1031 in my mind, because with a 1031 you don't recognize gain, you're holding the asset, you die, that's unfortunate, but then your heir gets the property with a stepped-up basis and there's no income tax. So that's great. Whereas with an opportunity zone investment, if you make this investment and then you die, that's still unfortunate, but your heir will step into your shoes and pick up the gain that you didn't pick up before you died. So that's not as great. But with the new round of proposed regulations, we have another thing weighing in favor of an opportunity zone investment that makes it better than a 1031. And that is, if you do a 1031, you had your old property and maybe it was fully depreciated, and if you get new property, you don't get extra basis in the new property that you get to depreciate. You're just stuck with your old low basis. But with an opportunity zone investment, you sell your old property, let's say you have 10 million of gain, you put that into a fund, the fund purchases new property, so it has $10 million of basis in that property, so it can depreciate that property, and you get ordinary deductions from that depreciation, and that might offset operating income, or maybe it's suspended if there's not debt, but at some point you'll get the benefit of these ordinary deductions, which is really nice, and you have to sit and wait for 10 years. And then when you sell the property, ordinarily the recapture of that depreciation is either ordinary income or it's taxed at a higher tax rate. But with, and here I have to add a lot of caveats because I'm a tax attorney. If you structure it right, and you have to think about this going in, you can't wait until the end. If you structure it right, you can sell the property and avoid the gain, like the capital gain and either the additional recapture from that depreciation. So that's something new to think about. One challenge with this is this part of the regulations is different from all the other parts of the proposed regulations, and then it says that you can't really rely on it yet. This is just kind of what we're half thinking about while we're daydreaming. So it's better than nothing to know that this is what the government is thinking about, but it's not as sure as some of the other guidance that we've received so far.
It's important to remember here that we have 45 minutes to describe to you something that we can talk about for 2 or 3 days.
That's right.
And each of the things that Kate has given sort of the higher level view of, there's of course a ton of background to what she would describe to you if she had more time to tell you all the fine tuning and details. So just bear in mind that there's a lot going on here at any one of these points.
And I'll add, we can start taking questions if there are questions for specific topics. Microphones are behind the projectors if anybody wants to address a question specifically. So if you just want to file in line, we'll try to address them as quick as possible as we have about 6 minutes. Yeah.
Can we turn on that mic? Or that mic?
This is on. This is on. Testing. There we go. Any malpractice attorneys in the room? I may need one. Question about your 179. I think it's for Forrest. 179 days. My understanding is in order to get the entire stepped-up basis of 15% for the sale, I've got to do that by December 31st, 2026. But you're telling me that if I'm selling a capital gain from a trade or business, I can't even elect to do that before December 31st, this year. So are you telling me that I